Abercrombie A&F is up 65% so far this year. It has been one of the hottest stocks of all. All right. This all talk takes us to our talk of the tape, how to play stocks into the year end. And here now to answer that question or questions, because I guarantee there'll be more than one. We've got Courtney Garcia of Payne Capital here with us at Post 9 and Malcolm Ethridge of CIC Wealth joining us remotely as well. That looks like D.C., Malcolm, if that's, I recognize our beautiful capital in the background. Both are CNBC contributors. Courtney, I feel like we just did this last night.
We did just do this last night.
On fast money.
Yes.
So I kind of got an idea of where you stand, but for any of those shamefully who may have missed that program, how do we, forget about today, how do we read the markets after Labor Day, going out the last 4 months of the year?
Yeah, and I mean, August and September, I mean, specifically this week in August, tends to be a pretty low volatility and low volume trading. But we're heading now into the end of the year, and you're starting to see some really good data on the economy, right? We just saw GDP revisions went up. You got the PCE numbers coming out. They're showing inflation's coming down. The Fed is set to lower interest rates starting next month. And all of that is really setting up as a positive backdrop for the stock markets. The big question is, how much is the Fed going to lower interest rates? It's pretty likely it'll be a quarter point next month and then maybe a couple more times this year. But all of that will be supportive for the markets, and especially the fact that NVIDIA is not necessarily dependent on the markets doing well is a good sign that that rotation can continue.
Yeah, Malcolm, listen, maybe we should take a page from Fast Money and play a game. They always do these games on FM5, Would You Rather, whatever. What do you think is more important for the macro market? Is it the Federal Reserve or is it NVIDIA?
I actually think the Federal Reserve is going to be the big winner here. And I think sort of to Courtney's point, that rotation that's going to come, I think all traders have basically capitulated to the idea that the Russell 2000 is going to be the big winner the moment that we get that first rate cut. So I would actually look for September to be a little bit more active than it usually is. But I also think that realistically financials are where that rotation happens, simply because the first cut in interest rates is going to impact M&A activity more than a lot of people are probably paying attention to.
Fair enough, Malcolm, fair enough. But I'm going to go back to you and ask you a question that I asked on Squawk Box this morning, because we're working, we're in, which is, does the Federal Reserve matter that much right now, given that the bond market appears to have already done the work of the Fed and bullied longer-term rates, the 10 years at 3.86. So it feels like the bond market already knows what the Fed's going to do and has moved ahead of it. So I wonder what any, rate cuts the next couple of meetings will actually do for the yield curve and for the markets.
So I will say just the one caveat to what you just said is if we don't get a quarter point raise like Courtney and all the rest of us are anticipating, if it's something larger, that could signal to the markets that maybe something's wrong here. The Fed has eyes on something that we maybe don't see. And I think that would be the one thing that makes what you just said a little bit different.
Courtney?
Yeah, and I think to add on top of that, the big thing is how it's going to affect the consumer, right? Because we are a consumer-driven economy, and when you have credit card debt that's, high right now, you're seeing mortgage rates that are high, it's really putting pressure on the consumer, and that really is kind of keeping a cap to a certain extent on where the economy can continue to grow. But as rates come down, you're going to start to see some of that pressure come off. That is ultimately going to be a good thing for the consumer, which is a good thing for the markets. So you're right, bond markets price it in, but I think it's what it's going to mean to that spending going forward.
Okay, let's have some fun. It is Friday, right? What if, and we didn't with the PCE today, right? The Fed's preferred inflation measure. Everything looks like it's softening. What if we got some kind of semi-reacceleration or stop in the drop in the inflation rate? What if the Fed, if we suddenly became, maybe they'll hold off the rest of the year? Not sure it's going to happen, but what if it did? What then for stocks?
Yeah, and I do think that's something that people should realize is a realistic possibility. That short-term rates are very likely coming down, but longer-term, there are still some inflationary forces in the economy, and especially depending on what happens in the election and any tariffs or things that could potentially be inflationary. Rates are likely coming down, but probably not to the rate that it was at over the last decade. So we could still be at a more elevated rate than we have been. And I think that's something people do need to realize, where I think it's what's going to happen next year. That's the big question right now.